Well, hello, everyone. We're back for Module 4. This is the fourth and final module of the sequence. At this point, you should have completed Module 1, which was on business planning. Should have worked with your mentor and actually applying that knowledge and developing your business plan and financial projections. Module 2 was on credit. We learned more about personal credit and business credit. And there were a couple tasks that you should have done there, including the personal financial statement and the soft credit pull. And with that, normally we would have been able to arrange your first tranche of financing, called the FTF, like the first round. Module 3 was on financial management. Maybe a little dry for some of you, but certainly some very important information of what you should know and frankly, what you should do with your small business to increase the chances of profitability and accessing capital. And now we're on to Module 4, the final module, which is on banking and money. So assuming that you've done the key deliverables, work on your business plan, talked about that Module 1, created your personal financial statement and authorized a soft credit pull from Module 2. You should have set up your collateral assignment, the key person policy, for Module 3. Now we're on to the fourth and final module. We'll go through this information, and then we're going to package everything together and put together your capital acquisition plan, we call that CAP, to figure out what the right source or sources of capital are based upon your mitigating circumstances. So let's not get ahead of ourselves. Let's go ahead and start talking about banking and money so we can get you ready to go for funding. All right, so our agenda, we normally do the welcome, which is kind of what we just did. For each of these lessons, there are the pre and the post evaluations or surveys. It's great for you to do that and then to share that with your mentor so we can make sure that you're learning what we think that you should have learned and that we're progressing. And we're going to go through our learning objectives here in just a moment. We're going to have a couple different sections for this module. We're going to talk about banking services. What banking services do I need? Excuse me. Section 2, which is even more relevant and probably more exciting for both of us, would be the financing options and sources. Again, there's 3 exercises you see here. I'm just going to introduce those to you. You're going to work with your mentor one-on-one or in small group, however he or she's working with you, to complete those exercises, and then we'll wrap it up. How does that sound? Okay, so banking services, building your banking relationship. We're going to talk about factors in selecting the right bank. We're going to talk about some key account services you should be aware of, as well as some other services. So this is the outline for section 1. Building your bank relationship. Well, I know that we live in this transition now where we used to have more personalized face-to-face experiences with others, and now so much is virtual and online. But when it comes to banking, it is great if you have a relationship with the bank that you're working with. And so you have a specific person that's assigned to you that you're able to bounce ideas off of and resolve problems and so forth. And that's the intention of bullet 1 here. Myths about banks. Banks don't want your business because you're too small. Well, often it's the opposite of that. Many times banks are looking for and even have goals of opening a certain number of new accounts. So don't think that you're not important, because you are. Secondly, banks don't make small loans, and that varies based upon the banking institution, but certainly there is the ability to get smaller increments of funding if we need to start small. Third, you shouldn't think that you need perfect credit history to start a bank relationship. Fourth, that loan applications take months and that fees are not affordable. So those are 5 myths that we wanted you to know. Things to consider. Well, what banking services do you need? What should you look for when choosing a bank? And with those, you're going to work with your mentor and go through the participant guide on page 11 to flush through that. So you can pause this recording and work with the mentor now, or finish the recording and back into it. But these exercises are important, just not the nature of what we're covering together through this video. So what are some factors in selecting the right bank? Customer service, access to your accounts and money, technology, and specialized small business products and services. And so we want to be strategic about it. Just because they have a list of 100 things that they do, it only matters if those things are relevant to your business. And that's why we go through that first exercise. Let's get a little more familiar with FDIC and insurance principles. So there is insurance that in case the bank should close, that your money's protected. There's certain restrictions or parameters around that, and that's what we're covering here. So in terms of account services, things like having business checking accounts, business debit cards, savings accounts, CDs, retirement accounts, business credit cards, payroll services. And we talked about the importance of using payroll in module 3, because even though you own your own company, we strongly recommend that you become an owner of a company, but you're an employee, not 1099, not considered self-employment. Well, for that to happen, you need to be on payroll. So we've talked about that, and you can use QuickBooks Payroll or whatever payroll service you want, but many banks will either internally or have a relationship with a payroll service provider. Cash management, merchant services, and that's where we're talking about credit card processing. It's very probable that you'll want to accept credit cards from your clients, and your bank may be a great resource for that. So there's going to be a cost of services. You know, we can't go into small business ownership or growing our small business and look for free. Most things in life are not free because they're offered by other businesses, and those businesses couldn't exist if all they did was free things. So obviously you'll want to be thoughtful in looking at the fees associated with your banking and account services. Account services, timing, ease, and security of payment transactions. And so this is getting to the fact of what type of lead time. There are some banks that you can run ACHs and they give you credit for it same day. And then if the payments don't clear, they reconcile them out later. Others make you wait until they clear, so that could affect your cash flow. So there are some significant differences in how banks operate and how you have access to your capital. So again, I would leave that for you and your mentor to discuss. And then as you're interviewing bankers, and that's really the mindset when I work for the SBA, that's what we always said. You should go interview different banks and decide which bank you want to work with, because they want you, and you have the opportunity to choose the right bank that fits your needs. In terms of account services, business checking accounts, what are some important considerations? Based upon the type of account you open may have some constraints on how much volume that it's set up for. There are rules, both contractually and federal and state, regarding checks. You need to be familiar with that. And banks use information to evaluate applicants. So for example, we talked back in module 2 about credit reporting agencies. So we have Experian, Equifax, and TransUnion on the personal side. On the business side, we talked about Dun & Bradstreet, Experian Business, and Equifax Business. Well, the truth is there's lots of other bureaus, and one bureau that's a specialized bureau for checking account history is called Check Systems, and that's the bullet we're on here. So if we haven't managed our checking accounts properly in the past, we might be flagged in the check system account, and that could impact our ability to open a new bank account. But truthfully, there are some banks that don't use check systems, and there's also ways to clean up negative accounts on check systems if that has happened. Account services, business debit cards. This is obviously, instead of having to write checks, which most of us don't do as a normal protocol in business, having a debit card that's linked to your business account to pay transactions. When you do that, especially if you're following the guidance we gave you in Module 3 about using QuickBooks or some sort of small business accounting software, then those transactions will normally record or transfer automatically into your QuickBooks for easier record keeping. Account services, savings accounts, showing that you're reserving cash for unexpected needs, CDs. So these are different options for saving money. And frankly, these two are not real relevant to businesses. It's more relevant to consumers. Additional banking services, again, payroll. We need to be thinking about getting a payroll service set up quickly if we don't have one already. It's going to give us easier record keeping. It's going to allow us to be compliant, reporting submitting our tax withholdings properly. We want to avoid any problems with that. Allows you to receive direct deposit. So again, don't think even if you're a one-person show right now that you're just starting your business that you shouldn't be on payroll. You should. You should have direct deposit set up as soon as possible for yourself through your business. It's common, and I mentioned this in Module 3, to have separate bank accounts, one for a payroll account and one for an operating account. And then there's a concept called zero balance that can help you manage your accounts and avoid fraud. So there's just enough in the account for a specific purpose. Additional banking services that might be relevant to you is strategies to manage your cash, and merchant services, which we mentioned, ability to receive credit and debit cards. And that's very important. While it may not fit your business model, in general, if you are receiving client payments by credit card, that can increase your access to capital and can even serve as a type of collateral for loans because it's predictable. It can be a source of collateral. Reconciling accounts, so you should reconcile at least monthly. Again, if you're using QuickBooks or something like that, it'll make it a lot simpler, but you want to be looking at your transactions and making sure that everything is accurate, that there's no fraud or mistakes. Key points to remember on banking services, and we're going to get into the more exciting topic, section 2, in just a second, but you want to build banking relationships early on. And I want to go back to that, so let me rewind. Here's my belief. I believe that every small business should have a CPA relationship. It's not what we're on right now, but you're going to need an accountant to help you, most likely remain compliant, file taxes, and you want to do tax planning as well as tax preparation. I think an argument can be made that every small business should have access to an attorney to be able to review agreements and resolve issues and have access to counsel. I think thirdly, which is what we're on now, every small business needs to have a banking relationship, and it should be more than, oh, I have my bank account with XYZ, but I have a business banker. I have a business banker that knows me, I know them, and I can talk to them. And then fourthly, I think every small business needs a capital advisor, and that's obviously what we would like to be for you in helping you position yourself for your capital raises. So I think it's those four professionals that should form kind of an advisory team for every business, no matter how small, how early on. Now, that's not to say that they're your board of directors, that's different, but an advisory board of a CPA, of an attorney, of a banker, and then hopefully us as your capital advisor is a great way to build a strong foundation. But back to key points to remember. So we need to have a banking relationship to build you want to build the relationship early on. Choose the bank based upon how it meets your needs. Make sure that you understand how the fee structure works and how funds are available, and look at additional resources that might be able to assist you. And then lastly, we need to reconcile to make sure that there's no fraud or mistakes. Okay, well, we made it through section 1. That was a little tough for us all. Let's get to section 2, which is a lot more exciting to me. And this is talking about financing, because that's what we're doing together, right? We're going through these 4 modules, of course, to build financial literacy. But throughout the process, we're working on building your loan package so we can do what? access capital. So let's talk about section 2. We're going to talk about financing options, financing sources, and financing readiness. The 5 C's. We commonly talk about the 3 C's, but we'll revisit the full 5. And we first talked about these back in module 2, but we're going to take a little deeper dive today. We're going to go through a loan readiness checklist, understand the cost of financing. It's very unlikely that there's going to be no cost of capital. So let's not go into this naively thinking I'm just looking for free money. There's typically not going to be free money. That's not the way that the capitalistic model works. So there's going to be a cost of capital. Now, is it a smart decision for you to pay the cost of capital that you're being offered in any given circumstance? It comes down to ROI, doesn't it? Right? So if I could go borrow $100,000, but I could use that and I could double that, would I be willing to pay a higher interest rate or a higher cost of capital if that were my only or best option? Well, sure, because I'm going to double my money. So it comes down to ROI. All right, so financing options. We have 5 little circles here, starting from the top left. We have savings, gifts, and informal loans. Often this comes from friends and family or ourselves from savings perspective. Next, there are term and installment loans. Top right, we have lines of credit and credit cards. And we work with clients often to help them get business credit cards. And sometimes people, they don't appreciate it as much as they should. Business credit cards are great. They can be obtained under the EIN, and so it doesn't report on personal credit. And a business credit card, frankly, is almost the same as a line of credit, right? If you need it, you can use it. If you don't need to use it, you don't have to. If you use it and as you pay down the balance, then that amount becomes available again. And that's different than the term or installment loans where it's a flat amount, and as you're paying it back, you don't get access to more of it. Bottom left, special purpose loans, and then bottom right, other financing. So in truth, there's a million different circles for financing options. This is just the goal to put them into 5 categories for simplicity. All right, so from a savings, gifts, and informal loan perspective, this is often used by startups. Gifts can be counted as business capital. We talked in module 3 about equity contributions, and there's certain ways that gifts can be considered an equity contribution. So that is one option: savings, gifts, and informal loans. Probably not the reason why you came to us to work with us, but it is a financing option. Terms and installment loans, which is the second, and again, so that's a defined amount of money that you're being lent, and with that, there's usually a specific repayment term. Could be a short term or long term. Usually there's a specific interest rate, and so if you make those payments on time, it'll be paid off in that defined period. It's not fluid like we're going to talk about on the next circle. But for larger amounts, or especially for fixed asset, this makes a lot of sense, term and installment loans. Funds are received once approved for a set amount of time, repayment installments with interest, and that's what we just talked about, isn't it? And so we will need a new application typically each time we apply for a new loan. And that's one of the benefits of the line of credit or credit cards I made reference to, which we're on now. So this is revolving. It's always available. You need it. You can use it if you need it, and you don't have to otherwise. Now, this bullet says it's generally secured. I don't agree with that. Lines of credit and credit cards may be secured or not secured, which means you may need collateral or not for them. I wouldn't agree that they're generally secured. Maybe it might be safe to say that lines of credit typically are secured and business credit cards typically are not secured. It can be used to finance any business expenses, and there may very well be an annual review. I was visiting with a vice president of a bank, BBVA Compass. His name's Mark, and we were talking about small businesses' use of lines of credit. And he brought up a really good point that maybe is obvious to you or not, but if you're talking to Mark, he would say, you know, how are you going to use this money? Because a lot of small businesses say, I want a line of credit. Well, a line of credit is meant to use and then pay off and use and pay off. There should be some fluidity. And what Mark was explaining when I met with him is that if a small business maxes out or continuously uses a large amount of their line of credit, the bank may close it because they're misusing it. That should have been a term or installment loan if they're always using it, if there's not some ebb and flow to it. So that's why we're going to work with you on putting together your your capital acquisition plan, to make sure that we're identifying the right sources of capital based upon your circumstances. All right, and so then both with lines of credit and credit cards, if you haven't used them, then there's no payment typically, and then the amount of payment that you have is based upon your utilization of that source of capital, the outstanding balance. So business credit cards, I think, are awesome. Right now, there are a lot of options for little to zero interest initially, because of the low interest rate environment that we're in. If it's set up correctly, it's going to report only under the EIN, so it won't reflect on your personal credit, won't affect your personal utilization, won't affect your debt to income. And business credit cards, we help clients get $10, $20, $30, $50, $100,000 of business credit cards. And so certainly, I'm not suggesting that it likely is your only source of capital for your capital raise, but it could be a very important part of your capital raise. Special purpose loans, there's special purpose loans for agricultural, for manufacturing, for VA military members, for exporters, disaster loans. So what we're talking about here is just that there's some specific types of special purpose loans. There are some loans that are offered through taxing authorities, whereby they can often be a little easier to get approved for than a traditional bank loan, and it's almost a reinvestment into given communities. So we'll evaluate that with you as we're putting together your capital acquisition plan. There are many other financing options. Don't overlook leases. Leases for equipment may make a lot of sense. We've even done some lease buybacks, financing inventory, factoring, credit card advances, and financing receivables. So we'll go through the different options based upon your mitigating circumstances and your preferences when we're building your capital acquisition plan. Purpose here is just to give you some understanding of that there's a broader set or sources of capital than you might have considered. Now, the SBA, I worked for the SBA up until July 5th of 1999, and so through a grant. SBA is typically not the lender, they are typically the guarantor, and they have different types of SBA loan programs. In general, let's talk about three types of SBA loans. So there's 504, which usually is to purchase fixed equipment or fixed assets or real estate. Then there's the working capital loans that fall under the 7A, and then they also have micro loans. And so don't be confused. And I know with the pandemic, there were PPP loans, but those are outliers, and that's not a normal part of the financing ecosystem. So the SBA typically is not the lender. They're usually the guarantor. So we're usually going to have to work through a lender to get approval. So frankly, in many cases, we have to meet two sets of criteria. We have to meet the lender's criteria as well as the SBA's. If the lender has tighter criteria, approval criteria than the SBA, you'll never even make it to the point of submitting to the SBA. But we can help you navigate through that. I've had a lot of success with SBA loans. So here's a graph that kind of shows the spectrum of financing sources and talks about how it affects the age or growth of business. So it's no surprise that based upon your mitigating circumstances, what type of capital is the best fit for you will change, right? As your company grows in maturity and cash flow and credibility, then it's going to have access to some sources of capital it might not have otherwise. But the bottom line is there's plenty of capital out there. We just need a good plan. We need to get the loan package put together. And ultimately, we need to meet the underwriting criteria of the source or sources of capital that we're pursuing. Here is another schematic showing about where you're at, the types of funding that you might qualify for. And again, I think it's very difficult to create these types of visual imagery because it's just not always the case. For instance, down at the bottom, it shows banks and credit unions wouldn't be applicable to startup and early stage businesses. And that's frankly just not all the case at all. We've had many instances of getting even SBA loans for brand new startups that are pre-revenue. So granted, different sources of capital have different underwriting criteria. This is their attempt to show you how it might play into based upon age of or stage of business. So you're going to work with your mentor on exercise 2 on page 27. I'll let you and they work on that. What are some things you can do to improve chances of getting a business loan? You can strengthen your personal and business credit history. We dug into that on module 2, didn't we? We need to be separating personal and business finances, the 5 C's of credit, which we're going to talk more about, building bank relationships, which we just covered earlier in this topic. And there are some specialized programs that might assist you as well. All right, so what can we do to improve our chances of getting a business loan? Well, so often clients will come to us and they want to not use personal credit. They only want to use business credit. And so that may or may not be possible depending upon the circumstances and the type of capital we're pursuing. But regardless, in general, we probably need to be of the mindset, what can we do to optimize both our personal and business credit profiles? And we talked about that quite a bit in module 2. What else can you do to improve your chances of getting a loan? Well, we want to try to separate business and personal finances, keep accurate bookkeeping. We talked about that extensively earlier. Want to work with a CPA, a tax advisor. We talked about that earlier today. What are other things we can do? We need to be aware of the 5 C's of credit. So we introduced this back in module 2. We'll take a little bit of a deeper dive here. What are the 5 C's of credit? Number 1, capacity. We call it cash flow, but it's capacity. Do we have the ability to repay a loan? Let's use a simple analogy. Let's say that you're ready to buy a new car. Do you go look for a new Porsche 911? Well, even if you had great credit, if you don't show that you have enough money to pay the loan payment, which is probably going to be expensive on a new Porsche 911, that's the wrong car for your circumstance. Well, if we're going to go borrow money to start or grow a business, do we have the ability to repay it back? And often, and there can be exceptions, but often the bank doesn't want to say, oh, only based upon you borrowing this money will you have the money to pay it back. It's what cash flow, and it's often referred to as global cash flow. What cash flow do you have from employment, if any, and from any other businesses that are operating now, if applicable? So it's just no surprise that many sources of capital want to see if you can afford to pay it back. With that being said, there's exceptions, and certainly we can get sources of capital that do not verify income. So you could have 0 income and still go get financing. But in general, your ability to repay a loan, your capacity is important. Collateral, different types of collateral. If we're going to go buy real estate, then of course the real estate would be pledged as collateral. We talked about, and you should have been working with your mentor from last module on setting up your key person policy, your collateral assignment. So there's different types of collateral, and frankly, different sources of capital have different requirements for collateral. So we'll work with you on that. Credit history of both. So the 3rd C is credit, both credit of the individual owner or owners, typically anyone 20% owners or more, as well as the business. But again, different sources of capital have different requirements. Some of them don't look at credit at all. Conditions in terms of loan and business environment, and then character. And the character, I can't emphasize enough, because, you know, when we're working with clients and you're working with your mentor, do you make your scheduled appointments? Do you do what you say that you'll do? Are you professional and accountable? You know, these are all attributes of character that will impact your access to capital. So how you carry yourself and your personal behaviors are important just as well as these other items. And so you can reflect how you rate on each. Now, I never worry about number 3 on credit, because credit is fluid and credit doesn't have a history. So if credit's not so good right now, that can change very quickly. So don't be down on yourself if credit's not a strength. Collateral, we can help create collateral. We talked about that. Capacity, cash flow. Well, if need be, we have some unique ways to help you generate new cash flow to be able to help you demonstrate the ability to repay the loan. So for a lot of this, it's fluid and it's manageable. And that's what makes us valuable, is we can work with you, not just to understand where you're at now, but how to get to where you need to be to accomplish your capital raise goals. You'll work with your mentor on this, on your loan readiness checklist on exercise 3. So I'll leave that for you and they to work on. What are some key points to remember? Types of financing include your own savings. Understand that different loan products have different options and different considerations. There are some what we'll call government or special types of sources of funding that you might qualify for that would be even more accessible. And there are financing. We can't just think about going to the bank. Going to the bank and getting a bank loan or bank financing is fine, but that may not be the only option or the best option for you. All right, we want to improve our chances of getting a loan by understanding our personal and business credit scores. We should have been working with our mentor on that back in module 2. Need to understand the 5 C's and realize we're not just stuck where we're at. We can improve any of those 5 C's. Maintaining separate personal and business records. We need to prepare. And again, when I was at the SBA, we caution, you know, don't just go to the bank and start a loose conversation. Be prepared before you go to the bank. Let's build a loan package and have that loan package prepared, because that's ultimately what the bank is going to want to see. Bankers are great people, and they care about reputation and community in most cases. And so I've seen so many clients be misled. They'll not be prepared. They'll just go in and just have a casual conversation with the banker. The banker is kind of optimistic. Yeah, let's go ahead and apply, because they really need to encourage everyone to apply, because that's how they hit their goals, but also to make sure that they're non-discriminatory. But my point is, I've seen so many people leave an initial conversation with a banker very optimistic for the reasons I just mentioned, but in truth, they don't have a snowball's chance in Haiti of getting a loan, because they don't have their loan package put together. They're not properly prepared, and we can't fix that first impression that's gone bad. So I'd recommend let's focus on getting the loan package built. Let's identify the right sources of capital, and then we'll go pursue financing. The order is important. And so we didn't go into this a whole lot, but I'll mention it. There's a concept called bank rating, and a bank rating is the average bank balance of your account over the past 90 days. So let's say that your average balance was $1,000. That's considered a low 4 bank rating. There's 4 digits, 1, 0, 0, 0. And a low is because 1 is the lowest whole number, right? Between 1 and 10, 1 and 9. So if you had $5,000 average bank balance, you're a mid 4. If you had 9,000, you're a high 4. Well, what's the point? Your bank rating matters, and a lot of people overlook that. We have clients that they keep minimal amount in their business bank account. Now, if circumstances don't allow anything other than that, we have to work around it. But if you can, you know, maintaining a larger balance, even if your business is pre-revenue or not even profitable yet, improves your borrowing capacity. So we'll work with you on that. We're going to look at your bank statements as part of building the loan package, and we can make some recommendations. But just keep in mind, and maybe this is obvious to you, but for many it's not. Let's say your average bank balance is $234 and you want to go borrow $100,000, and the monthly loan payment is going to be more than what your average balance is. Well, to the banker, they're thinking, well, there's a disconnect. They don't have the capacity to be able to borrow. So don't be scared away from this information I'm giving you about bank ratings and liquidity, but we need to be thoughtful of that, and we'll work with you on that. We're building your capital acquisition plan out. There are resources available to you, including the small business financing checklist and the loan readiness checklist. And of course, us as your team. All right, so wrapping this up, get with your mentor, ask the questions that you have, review what you've learned, complete the training evaluation, which is shown here. Once you finish module 4 and you've uploaded the requested documents, which your mentor will help you with, into Dropbox, then you kind of move from your mentor over to us, to our team. And then myself or one of our teams is going to be working with you on developing your capital acquisition plan and getting you funding. So the mentor is important. They've been there to assist you through this 4-module curriculum and getting everything pulled together. Now you're ready to, once you finish that, you're ready to pivot over to the fun part, in my opinion, which is the funding. So here, just in review, make sure that you've completed the evaluation form, and share that back with your mentor, and make sure that you've gone through and done the checklist with your mentor. But most importantly, here at the bottom, I'll put them both. So you're going to work with your mentor to populate, which means put in the requested documents into your Dropbox folder. There's a specific Dropbox folder that we set up, and we provided that link to your mentor when you first enrolled. So he or she's going to work with you to get the files that you have into that Dropbox. That's like a virtual file cabinet. It's secure, it's private, but that's where we need to get the data to put together the capital acquisition plan. And then that's going to be our roadmap. Because you and I could say we want to go take a trip, but if we don't know where we're going, we're not going to be able to plan to get there. And so it's through this 4-week process of learning, of building our loan package, that's going to allow us to put together the capital acquisition plan and help you accomplish your funding goals. So again, it has been just nothing but an absolute pleasure to work with you over these 4 modules. I know it's been a bit of a one-sided conversation. You hear me and I don't get to hear you, but we're about to pivot that over to now. Once we get your Dropbox populated, you're going to be ready to work with myself or one of our funding advisors to finish this out and accomplish what you set out to do, which is to get the capital that you need to start or grow a business. Thank you so much, and I look forward to talking to you live here soon. Have a good day.